All right, future CPAs, welcome. Today, we're going to crack the code on a topic that you are almost guaranteed to see on the LSCPA, cash and property dividends. Let's get into it. Okay, picture this. Your company declares a dividend, but instead of a check, they hand you the keys to a condo. Yeah, it sounds a little wild, right? But it actually happens. And trust me, knowing how to account for it is a classic exam question. So let's break down exactly what you need to know. So here's our game plan. We're going to start with the absolute fundamentals. Then we'll decode cash dividends, and after that, we'll master the trickier property dividends. We'll even walk through a timeline example to see it in action, and we'll finish up with a super fast bullet review to make sure all of this sticks in your brain for the long haul. All right, first things first. Before we can even talk about paying dividends, we need to lay down the ground rules. These are the non-negotiables here in the Philippines. Okay, so this is the single most important rule you absolutely cannot forget. It comes straight from the revised corporation code, and it's simple. No unrestricted retained earnings means no dividends. Period. End of story. Think of it like a bouncer at a club. If you don't have those unrestricted earnings, you're not getting in. You're going to want to screenshot this slide. This is your ultimate study hack for what you can't use for dividends. See the pattern here? These are all what we call paper gains. You know, they look good on the financial statements, but they aren't actual cash in the bank yet. The SEC is super clear about this. You can't give away money you don't actually have. Burn this idea into your brain. It's a core principle. Okay, let's switch gears and talk about the type of dividend you're going to see most often. Let's figure out how we slice up the pie with cash dividends. So here's the good news. The accounting for cash dividends is pretty straightforward. A 100,000 peso cash dividend, you record a 100,000 peso liability on the declaration date. Easy, right? The real puzzle is figuring out who gets paid first and how much. So the first question you always have to ask is, are the preference dividends cumulative? Think of it like a running tab. If they are cumulative, any payments the company missed in previous years, we call those dividends in arrears, have to be paid out in full before the ordinary shareholders get even a single peso. Next up, do they participate? If they're non-participating, it's simple. They get their fixed rate, and that's it. But if they are participating, things get interesting. It's like a bonus round. First, preference shareholders get their fixed rate. Then, ordinary shareholders get a similar rate. And if there's still cash left over after all that, they both get to share in the rest. It's how they get an extra slice of the pie when the company's doing really, really well. So, here's your mental checklist for cash dividends. 1, they're measured at face value. 2, you create that liability on the date of declaration. And 3, this is the big one, always check those preference share features first. They dictate the entire allocation. Okay, deep breaths. Now we're getting to the main event. This is a huge topic on the LECPA, so listen up. We're talking about property dividends, also known as dividends in kind. And here it is. This is the single most important difference you have to remember. With cash, it's face value. With property, it's fair value. I'll say it again, fair value. Forget what the company originally paid for the asset. Forget the book value. All that matters is what it's worth on the open market right now. So what does that mean in practice? Well, the second the board says, we're declaring this property dividend, you immediately have to figure out the fair value of that asset. It could be a building, inventory, shares in another company. Whatever it is, you find its current market value, and bam, that's the number you record as your dividends payable. But wait, there's a twist. What happens if the value of that property changes between the day it's declared and the day it's actually handed over? See, that's the million peso question. The value you record on day one, that's just the starting point. The liability isn't set in stone. So let's make this real. We're going to walk through a classic LEPA style problem so you can see exactly how this works. Our asset in question? A one-bedroom flat. Okay, so here's the setup. A company has 5 shareholders, and it's decided to give each of them a one-bedroom flat as a dividend. We need to track the accounting for this on 3 very important dates. So, on December 1st, the declaration date, each flat has a fair value of 1.5 million pesos. We've got 5 shareholders, so 1.5 million times 5 is 7.5 million. That's our initial entry. We debit retained earnings and credit dividends payable for that amount. Got it? That's step 1. Now, fast forward to December 31st, our year-end reporting date.
The property market has been hot, and now each flat is worth $1.8 million. So what do? We have to remeasure our liability. $1.8 million times 5 gives us a new payable of $9 million. That extra $1.5 million gets recognized as an adjustment, increasing our liability.
And now for the grand finale. It's January 31st, settlement day. This is when we actually hand over the keys. The flats are now valued at $1.9 million each. We do one final adjustment, bringing the liability up to $9.5 million. At this point, we can finally distribute the assets and clear that payable from our books.
You see the pattern here? The big takeaway is that a property dividend liability is not a set-it-and-forget-it thing. It's a moving target. You have to keep updating it to reflect fair value at these key dates: declaration, reporting, and finally settlement. That's the key. Okay, let's lock this all in. Time for a final rapid-fire review of the most critical rules. Think of this as your high-yield flashcard moment right before the exam. Rule number 1, dividends only come from unrestricted retained earnings. This is the ultimate gatekeeper. No exceptions, it's the law. Rule number 2, cash dividends, they're measured at face value. Simple as that. What you declare is what you owe. Rule number 3, property dividends are a whole different ballgame. They're measured at fair value on the declaration date. You gotta ignore the book value. And rule number 4, this is the one that trips people up. You have to remeasure that property dividend payable. At each reporting date and at the settlement date, you adjust for fair value changes. Don't fall into that classic LIPA trap. And that leads us to a great question for your next study session. It's a bit of a level up, involving probabilities and fair values, but it builds perfectly on everything we've covered today. Keep digging into those standards, keep studying, and you are absolutely going to ace that exam.